Well, our next guest says that the Brexit vote is now the biggest influence on the yuan. Let's hear from Darek Kowalczyk, senior economist and strategist at Credit Agricole CIB. Darek, why?
The Brexit vote pushed renminbi to 670. It stoked a lot of concerns in Beijing that there will be more capital outflow. They guided the currency significantly weaker. And the reason why we came as low as we did in July is precisely Brexit. But obviously, by now, things have calmed down. China seems to be more confident about its own growth.
In fact, it's been edging up, hasn't it? It's been appreciating with the blessing of the central government.
Exactly. We are 1.5 percentage points higher than we were post-Brexit. So it seems to us now that capital flows have stabilized. In fact, the latest data shows that there was more flow of hard currency to China most recently than away from China. And we are fairly confident that as we move to G20 summit in Hangzhou and then to the inclusion of RMB in the SDR basket in October, policymakers will have a bias towards further appreciation. And renminbi will be a fairly strong currency in the second half of this year.
You think it's going to be a strong currency looking ahead for the next 2 years, aren't you?
Exactly. So we do not agree with the naysayers in the market who are panicking about Chinese growth, about capital flows. These concerns were relevant perhaps in the second half of last year, but by now growth has clearly stabilized. Capital flows are turning much less negative. Current account surplus will be stronger in the fourth quarter, as it usually is. There will be a net demand for the currency in the coming few months, and it will reappreciate. Not massively, but it will definitely not be as weak as most in the markets are saying it will.
Right, Darek, a couple of years ago, you and I would be talking here and would be mentioning the internationalization of the RMB, and a lot of that has happened, certainly. But we'd also be talking about when does this currency start to freely float. That debate has sort of gone to the sidelines, hasn't it, to some extent?
That's true, and it's partly because internationalization did make some progress. It has stalled recently because it's more difficult to move to a weakening currency, which is partly why China, I think, will want to strengthen it to ensure that internationalization re-accelerates. But when it comes to the free float, the progress has been very slow, and the Chinese have indicated that they will continue to control the currency very tightly for a very long period of time. I don't expect a full capital account opening in any foreseeable future because it's just too dangerous. Too much money would flow out of China. So I think that it will be a tightly managed currency with only gradually increasing volatility. A full free float is definitely not on the cards.
Okay, well, another reason why it could be appreciating is this belief that perhaps it is steady as she goes when it comes to the Chinese economy, and as a result that the central bank is unlikely to do anything in terms of reducing the cost of borrowing, reducing interest rates, in other words, or even doing something to the reserve requirement ratio.
I think it's much less likely that there will be monetary easing now that Q2 data was fairly strong. China feels confident that they can stimulate its economy based on domestic demand and that they do not need to reach for exports. And in fact, when you look at Q2 data, negative contribution of trade to growth that was very, very strong in Q1 has almost disappeared. So they don't feel that they need to do any sort of competitive depreciation. And that gives us confidence that they are confident enough in a strong currency to be consistent with achieving their growth targets.
Question is, of course, what happens down the line when we actually do get some serious structural reforms, and perhaps then we get unemployment and the genie's unleashed.
This will not happen. Structural reforms will be very gradual. They cannot afford serious unemployment because it would endanger social stability, which is paramount, which is much more important than what happens with renminbi, much more important than what happens with the actual growth number. Employment is key, and they will not do anything that will change that. In fact, if you noticed recently, President Xi said that the public companies have to become bigger and stronger.
We were talking about structural reforms, and saying that President Xi's stated aim is to actually create bigger companies. Well, surely that would mean M&A creating national champions, and then, if you get two zombie companies together, you don't necessarily create one big zombie company. You can actually create a successful conglomerate there. Now, the thing is, you'd have attrition, so that is structural reform in its own way.
To a certain degree, yes, although I think that the attrition that is happening will be partly at the managerial level, which doesn't show big numbers, and partly in a very controlled way, the way they are dealing with the steel overcapacity, where the cuts in output capacity are actually quite modest. So they are not going for a 90s style of reforms where millions of people would lose their jobs. I think that at this point, with much weaker economic growth, this will not be the way for China. They will take gradual steps only, and therefore the SOEs will continue to be the key drivers of growth, the key drivers of investment, both domestically and in terms of M&As abroad.
Exactly, and Darius was saying this, and we get business investment later this week. This should be showing exactly what you're talking about. Unfortunately, from the private sector, there's little or no growth.
No growth at all anymore from the private sector.
In terms of investment, we should say, it's all public money right now, isn't it?
Well, obviously, there's a lot of private money, but it's not increasing vis-à-vis last year, so that's why there's no growth. But still, more than half of investment is coming from the private sector, but growth is coming from the public sector, because this is the sector that has the support from the banks, that has the policy priority to drive economic expansion, and that has the confidence in the achievement of the growth targets. So, unfortunately, it will not be the kind of reforms like we saw in Eastern Europe, for example, 2 decades ago, where the private sector was allowed to roam free. This growth driver in China that we are seeing is public, will continue to be so, which means that probably there will be less return of investment, but more certainty in terms of the kind of expansion they are going to achieve.
Thing is also there, very quickly, doesn't it have this crowding out effect as well, with public money crowding out the private?
Well, yeah, obviously, but that's part of the policy push. They want to consolidate power in the hands of big SOEs to control the economy better, perhaps to have greater political control, and to have a stronger impact on how quickly and along what trajectory the economy expands.